Welcome to Trillions. I'm Joel Weber.
And I'm Eric Balchunas.
Eric, everyone thought that crypto and Bitcoin were going to go away, maybe. Well, not everyone, but some people. And then all of a sudden, SBF went down and Bitcoin kept coming and kept coming and kept coming. And here we are at a high that we haven't seen for more than 18 months. And a lot of that enthusiasm is about the prospect of an ETF.
Yeah, no, this is huge. Ever since BlackRock iShares filed in, I think it was June of 2023, there's been a lot of excitement about spot ETF approval. The SEC lost a lawsuit with Grayscale. That was another huge catalyst. And then we've seen very, very good news in terms of these legal documents getting updated, which shows the SEC working with issuers. So we are basically, if this has been a 10-year journey, let's call it a marathon, we're literally in the last mile. We're on mile 26. So it's a big deal. This marriage has been, something in the mix for, again, a decade. And when it finally happens, there's a lot of, it's like building a bridge to the advisor world in particular. And so, we thought one of the main players is ARK and 21 Shares. They were honestly filed before BlackRock. They deserve credit for having probably the most vision of figuring out this is the cycle. And so their filing is actually the one that has the first deadline in January. So because of them, we're probably going to see an ETF on January 10th, or at least approval by then. And so, it's great to have both sides of that prospectus, both ARK and 21 Shares on the podcast today.
So joining us, we've got Cathie Wood of ARK and Ophelia Snyder of 21 Shares. This time on Trillions, let's talk about Bitcoin some more. Cathie, Ophelia, welcome back to Trillions.
Thank you, Joel. Thank you, Eric.
It's good to be back.
Okay, so Eric described this as a marathon. We're in the mile sprint to the finish line. Are we going to get across that finish line?
I think this is the perennial question. And I think I've pretty consistently said the same thing on this, which is that if you would like a different outcome, a pattern break is a good thing.
I have to give 21 Shares a lot of credit on that because, we were denied, and we just kept filing. And it was because 21 Shares, the grit, the gumption, the determination, which is very much in keeping with the way we work as well. So I think that's why we're first in line.
Okay, so there's this January date that's going to happen. The 10th, Eric says. What's going to happen on the 10th?
Everyone is very focused on the 10th. Makes a ton of sense. Completely understand why. It's not how this works, actually, right? These windows aren't quite as clean as what people seem to say, right? So it's completely conceivable that it's before. It's completely conceivable, we hear something day of. If you look at previous rejections and delays and approvals, day of is not necessarily like the key window. But I think from the minute you hear go, what's going to happen is it's going to boil down to who's actually ready to go. And it's not just a question of like the regulatory documentation, critical component. But has everybody actually operationally set up these products in the background? Because the SEC says go, whatever that ends up being, you're going to have everyone jump at the same time. And it's going to fundamentally be a question of who's got APs on board? Are the custodians ready? Are the accounts open? Have you actually completed the process? Is the exchange ready to go? Like, how much of this have you actually operationalized? And I think that's a much bigger deal at an infrastructure level than anybody thinks right now.
It's been interesting as different firms, we've been doing due diligence with different firms, and some of those who have filed really haven't issued ETFs before. So they're trying to figure out, wait a minute, who do we choose among this field of perhaps 12 if they approve all 12 at the same time? And they're really thinking about, okay, I'm only going to pick 3, maybe. So, and they're beginning to delineate, okay, these are my check boxes.
And I think one of the things that's so undervalued is client service and client support. So obviously there's actually a third piece here, which is Resolute and some of the distribution on that side. Like at the end of the day, this is going to come down to, you're going to get a go. Are you ready to actually do it? Is the thing you're bringing to market high quality? Because one of the things that I think the world is sick of is crypto products that are both more expensive and less good than what you normally get. That's not going to work anymore. So it's going to be a question of, are you bringing something that's high quality? Can you do it quickly? And are you going to be able to actually help clients? Because client service is huge here. You've got advisors who are looking at entirely new asset classes for the first time. Like, are you ready to answer those questions? Because they're going to have them. And you need to actually have answers and have a way to support them through that process. So I think you're going to see a flurry of operational activity followed by a very steep educational curve for the client base as they try to get up to speed and try to figure out, like, what are we doing here? Most CIOs' offices don't have a policy on crypto yet. And if they do, it's negative. So what's going to happen here in terms of their need to be responsive to their own customer bases as they start to allow product on platform, as they start to get comfortable making allocations? It's going to be a very critical time for crypto as an industry in terms of welcoming a whole new cohort of players. And it actually goes back to, and I mean, this is the whole core of ARC, right? This is about research and education and providing people who are curious about this space with a gateway.
Our first research piece on Bitcoin was in 2015 when it was $250. And we asked the simple question, it was a white paper, can Bitcoin serve the 3 roles of money? And we did that in collaboration with Art Laffer. And when he really understood what this was, he said, I've been waiting for this since they closed the gold window in 1971. So 2015, and then the next year we wrote, ringing the bell for a new asset class, Bitcoin, ringing the bell for a new asset class. So we've been trying to educate the market. And I remember in the early days, 2015 especially, many people dismissed us, that's a marketing gimmick, Bitcoin market, nothing but a marketing gimmick. So we've come a long way.
Oh, yeah, absolutely. I was skeptical myself. I remember the first one filed, the Winklevoss ETF in 2013, Bitcoin was $99. So I knew about it, and I'm kicking myself for not buying any because it was. I remember I was doing a TV hit around then about the filing, and Matt Miller was way more up to speed than I was. I could have acted then, but I was like, this seems so silly. I don't know. It just seemed like, I don't know, like almost like a little bit of a fun craze, like something that would just go away, like a fad. Anyway, I want to go and talk. I know, Cathie, you bought GBTC in the early days with ARKK, and you made it was a huge trade. It powered a lot of your returns early on. So I know you were in it early. Now, Ophelia, 21 shares, is over in Europe. You're launching all these ETFs. At some point, you guys met, and I guess talk me through that, and then the filing in April. I mean, and how you guys work together on this.
It's actually a lovely story. Cathie and I have known each other for a while, way before this partnership was public. I was a super green, had just started my company, going to my first gathering of people who know stuff about ETFs. And I sat down next to Cathie at lunch and we started talking. And there was such a wonderful alignment between our philosophies as firms, our views on crypto. We come at this from a very different perspective. I'm a total wonk for structuring and things and regs, and I think Cathie definitely comes with more of a visionary technology perspective. And we just got to talking. It was such a good match that we kept in touch, and I was building an ETF business for the first time and transparently had a long way to go in learning how to do that. And it turned into, I think, a very productive and very enjoyable friendship and relationship, and that it was the genesis of these products.
So I can give you a little bit more inside scoop here. This was at the annual ETF confab called Dynastia. And I remember, yes, being late to the lunch, sitting next to Ophelia. And then she started talking, and I said, I know what school you went to, and I know what school within the school you went to. You went to Stanford, the Earth System School at Stanford. And she was shocked because nobody knows about that. But if you'll remember Chris Berniski, he was our first crypto analyst. And I heard Ophelia talking and thinking in the way that he did. So that's what really got us going. And then I definitely understood early on how much into the ops and infrastructure and platform part of the business Ophelia was. And it was not what I do. But I said, I want you to meet Tom Stout, who's our COO, because he loves the same things that Ophelia does. And we were looking for someone who could help us with the platform play, the infrastructure play associated with Bitcoin. So, very quickly, we became fast friends professionally as well.
So you got together, you're filing for this ETF. Do you guys talk every day now because we're sort of at the 11th hour here? How often are you communicating? Or Cathie, do you just sort of let Ophelia drive this because you've got the stocks to pick? I mean, how's this work, I guess, today?
I think Ophelia and Tom talk at least once a day, if I'm yes,
if not more,
if not more, and we get together. I'm updated all the time, but we get together regularly to compare notes and just make sure that we're all on the same page. We have to get everything right. This is really important.
And one of the things to realize is we already have 5 funds out as part of this partnership, right? And we already have a suite of crypto ETFs that came to market a couple of weeks ago. So it's not just a question of, I think, Cathie and I, and not just a question of Tom and I at this point. There are touch points across essentially every layer of our organization.
Absolutely.
We're already in the trenches operating product together.
Yeah, our marketing teams are working very closely together. Our research teams are working very closely together. So it's across both organizations.
Okay, and so these new funds, so for people who don't know, obviously the main headlining act is the spot Bitcoin ETF race. But there is this sort of undercard with the futures. And obviously there was a Bitcoin futures ETF put out, then Ether futures were approved. You guys have put 5 or 6 products out. One of them is an active Bitcoin futures strategy. One's an Ether. One looks like it's
Ether futures,
right? Yeah. So these are all futures. Mm-hmm. I guess given when I saw these, I'm like, I get it, but given that spot is so close, and the futures ETF's probably going to be a little outdated. Most advisors prefer spot when given a choice. We've seen that with gold. They don't really want to use the futures. Give me the logic there, given that we're so close to spot, why put all these futures ETFs out?
So a couple of things here. The premise I agree with. I think spot is a more accessible product for most people most of the time. I think futures, similar to gold futures, are going to have a reason to exist and are going to be a critical part of certain profiles investments and how they choose to enter that market. And I do believe there will be a use case for them similar to what we've seen in other commodity markets. Beyond that, with this suite, we took an approach of bringing a series of highly differentiated products, right? That these are not really exactly the same as what was in the market before. At a strategy level, you're looking at a product that is strategic allocations of Bitcoin versus Ethereum, Bitcoin versus cash, and a true multi-asset product. These are designed to solve a very different set of problems for investors. Crypto is a massive, massive industry. This is not going to be one size fits all. Different people are going to have different issues, and this allows customers and advisors to take advantage of our expertise as a crypto firm. We've been doing this for 5 years. ARC's expertise in active management, some really sophisticated on-chain analytics, all of the benefit of our research and ARC's active management, as well as our operational excellence. And it really packages these products. They're fundamentally quite different than something like just a pure play Bitcoin spot product, because that's not really what they're intended to do. The vast majority of the suite is not intended to be a long-only exposure, but rather more sophisticated exposures that take advantage of that knowledge base from us as a firm, or actually as two firms. And so that's, I think, one of the key things with why we chose to do this. We don't believe that this is going to be one size fits all. We intend to provide clients with solutions that fit their needs in this space, that lets them take advantage as much as possible of our experience and expertise in the sector.
And I would say we have been investing on the research side in our team. We have 3 crypto analysts, one of whom does nothing but on-chain analytics. And what's beautiful about this ecosystem, especially Bitcoin, but others as well, Ethereum, the transparency of these ecosystems gives us a lot of information to manage actively. And so this is the first time, while we've been developing these tools for a number of years now, this is the first time we've been able to activate them in a productive way. So I'm pretty excited about that.
Okay, so obviously you two are both big bulls and have, a stake in where this product can go. There's still remains plenty of naysayers, even Jamie Dimon coming out and basically saying that if he were in the government, he would just shut crypto down.
He said that. Yeah.
So
crazy.
So you're still having to wrestle with a version of haters, right? And I think the haters actually for a while within the last year and change kind of gained a little bit of an upper hand with the carnage that came out of the SBF fallout. So how do you wrestle with that sentiment that still remains, which is like, there's no point to this. Why should I even bother?
So I'll start there. I had to defend what we were doing throughout last year. So Terra Luna, Celsius, 3 Arrows, FTX. And when FTX blew up, I basically said, and I think it's now clear, that, wait a minute, this proves the value of Bitcoin and other cryptocurrencies. Bitcoin, completely transparent, decentralized, no counterparty risk, whereas FTX, completely opaque, centralized and fraudulent. So that was the first step. But even more provocative, I thought, was during the regional bank crisis in March, as you pointed out earlier, Joel, Bitcoin went up 50% as the KRE, the regional bank index, was imploding and SVB and Signature went under. And we were able to say to our clients, wait a minute, Bitcoin is not just a risk-on asset. It is now showing its stripes as a risk-off asset when there's a financial crisis and counterparty risk becomes a question, because that was a question with the regional banks. I think that has gotten a lot of people's attention, as well as others in the industry who were negative. And you're right, it's so interesting to see Jamie Dimon and Elizabeth Warren on the same side of and agreeing with each other. Kind of what? But someone like Larry Fink coming around after years of focusing on the environmental issues that he thought were a part of the Bitcoin ecosystem. And, I think one of the most important things that actually happened 5 years ago when Cambridge Associates published its first report on crypto and focused on Bitcoin in particular, and basically said to its foundations and endowments, look, you may not like this instrument, but you should get to know as much as you possibly can about it, because this seems like it's a new asset class with a very low correlation of returns to other assets. And so I think, but one by one, these points are, I think, are hitting home, hitting a responsive chord. And I do think the SEC coming around and blessing a Bitcoin spot ETF is going to check the box for a lot of institutions.
When the SEC does whatever it does, and let's say that it approves, right? I'm curious what kind of modeling you've done. What happens to the price of Bitcoin when that headline moves that SEC has approved a spot Bitcoin product?
Some of it's happening right now, right?
But that's the lead up, and there's this anticipation.
Yeah, this is the buy the rumor moment right here.
Building for that moment, but what happens at that moment?
Yeah, very often, you will get a sell on the news because, and I don't know where it will go between now and then, and you could have a sell on the news, and you'll get maybe some weak holders in, kicking and screaming, and they may sell, but when you think we're at roughly 19.5 million Bitcoin outstanding, and we're only going to 21 million, and I really do believe that, knowing some of the core developers the way I do, then I think this institutional push in will be the biggest reason that our target, which the base case is 650,000 and the bull case is 1.5 million. One of the reasons that we have a shot that those numbers are close to the mark is the institutional interest in a new asset class.
Can I ask just about how just because those numbers are what they are, when you do the research and the modeling to get to those prices, how does that math work, Cathie?
And you'll see this in our Big Ideas 2023. We delineate what we are assuming for 2030. Those numbers are 2030 numbers. When it comes to digital gold, that role, the institutional push, and the use of Bitcoin in emerging markets, which have from a use case point of view, when economies are hyperinflating their money and spending egregiously and are corrupt, there's all the reason in the world to look for an insurance policy like Bitcoin. So those are the three biggest reasons we think it will go there. But just the institutional case alone, and we did write a piece on institutional, I think it was last year or the year before. But if you do the analysis, if you, and you're an institution saying, this is a new asset class, if you want to minimize volatility, you will probably take it to 2.5% in terms of an allocation to a new asset class. If you want to maximize your Sharpe ratio, so we're speaking their language, you'll look at something closer to 6 or 6.5%. So those are the bull case is based on that 6.5%. Now, why are these numbers making sense to us? Well, if you look at new asset classes, so in the 70s and 80s, it was real estate and pension funds. In the 80s and 90s, it was emerging markets as a new asset class. Institutions tiptoed in with 1%, then 2%, then end up at 5% or roughly thereabouts. So it's not crazy. These are not crazy numbers. And we used a Monte Carlo analysis to get to them. So that, I guess, is the biggest source of the upward move in Bitcoin from our point of view.
And one of the things people don't realize, and I think there's been a lot of statements made by people about the sell the news concept and what that's going to look like. And sure, yes, you may see that. I think what you're going to end up seeing that is a little bit unexpected is there's less of a question of what does it take to get people off of zero? Most RAs, most managers, most advisors are currently at zero. And the reason for that is there's not really a good way for them to access them. And typically the counterexample is, well, they can buy spot. But in order to do that, you need to set up a new custodian, a new set of trading relationships, all new reporting. It's unclear how that tax reporting is going to work. Does this integrate with any of your systems? How are you displaying that to your clients? Like, the operational burden and overhead associated with this is unbelievable. So even if you wanted to today, how much of an allocation are you even able to make? And would you be able to access that in the first place? The answer is probably no. And so aside from this sort of regulatory clarity that comes from this kind of structure, as well as some clarity around like tax and efficient trading and all these other things, there's this idea that I don't think the market currently realizes what getting off of zero looks like for the big players, right? Because a couple basis point allocation is a lot of money. It's way more money than crypto sees or understands conceptually. Like, there's a reason this podcast is called Trillions and not billions or millions, right? Like, there's a difference in what these numbers look like, and it's very difficult for people to actually conceive of. So whether or not you have managers like appropriately timing the market, a lot of them may just throw something to get off of zero. If you have enough of that dynamic of like, I'm just going to dip my toe, I'm going to put 1 BIP of a portfolio in there because, like, why not? That is going to proportionally look very different than the kinds of flows that you've seen historically in this space. And I think that's something that is not fully, that's sort of what when I hear this concept of institutional adoption, I think that's oftentimes misconstrued. There's a very real barrier to entry here. And I think to some extent that feeds into the narrative that Cathie is discussing. When we look at it, we understand this client base. We've been serving this client base in other geographies for years. Their issues are very real, but that market is significantly larger in the United States.
Yeah, I'll just add one thing, one for the institutional side, one for more retail. Mass Mutual put $100 million in, I'm going to say maybe, Ophelia, was 3 years ago, 3 years ago. And it meant nothing. It was a 0.0 something percent of their book, right? So that 100 million is against, where are we right now? A $1.5 trillion total market cap for all crypto assets, right? So that 100 million was 0.00 something, So that gives you a sense. And then on the, this is more on the corporate side, I should have said. Remember when Tesla and Block and MicroStrategy, they put Bitcoin on their books. There's been a very important ruling in the last few months from FASB saying this is no longer needs to be accounted for as an intangible asset, which you can only mark down. And instead, they are now going to allow mark to market, I think officially in 25, but you can start doing it in 24. So we may see corporate treasuries move in here too.
So just my 2 cents on that. I largely agree with you. I think advisors in particular love the ETF. That is their preferred vehicle. I got to tell these crypto people on Twitter all the time, like, he's like, why would you even need the ETF? I'm like, you understand, a lot of people just like to click a button, own it with the SEC stamp of approval. It's liquid. It'll be 1 basis point to trade. It's just something they're comfortable with. It's their familiar place. And I was like, well, maybe if 0.5% of the advisor assets, that's 30 trillion, go in, you're looking at 150 billion. That's about what gold has, a little less. So I see it somewhere in that ballpark. Now, the institutional money, a lot of times they wait till something's really liquid. Like, they tend to love the liquid ETFs. It's harder to get them into something that doesn't trade a lot. So I want to fast forward to the race. And this is where I think the race is so fascinating and why I'm so obsessed with this, even though it's probably going to make up 1% of ETF assets. I spend like 40% of my brain power on this. I'm even getting pushback from some people on Twitter who are like, hey, easy, take it easy. And my Ethan on my team makes fun of James and I constantly. Anyway, but this is just so high drama. The race is going to start, as Ophelia said. Some people may not make it to the starting line. Let's say there's 6 people who launch, 6 issuers. Let's say you're one of them. It's usually a winner take most. And the one that gets really liquid, probably going to have better luck in the institutional crowd because they just love that big liquidity. They don't want to like be like 100% of the assets or anything, and they want to have less impact costs. So how do you position yourself in the race to get liquid and get some mojo going early on if you got a BlackRock and a Fidelity next to you? One of my theories is that you're going to sell GBTC and put 130 million right into ARC-B, which is going to show up as flows and volume, which I think is an ace up the sleeve. So that's what I would do if I were you, but I'll get your take on it.
Well, we have to be very careful about what we say right now. GBTC right now is at 2%, and we're at least in print at 80 basis points if we're approved. So there's a certain logic to what you're saying, of course. We just there are also there are also some tax issues that we do have to focus on as all this is happening, and some of that will depend on what happens to the price between here and there. So I really shouldn't be talking about it. We have to be very
keep talking.
careful.
It's okay.
Well,
No, I hear what
how
you're
about
saying.
this one? I can talk about how we're thinking about this. Look, a big piece of this is capital markets infrastructure. Everyone right now loves talking about like the create redeem structure because it's like the topic du jour from the SEC
That's how
process.
Eric puts his kids to sleep.
Well,
Yeah, like
I'm sorry.
rockabye
I'm
baby,
sorry.
create redemption.
Real quick though, I heard back channel the SEC will only allow cash crates in the first tranche to go out. So if you want to do in kind, which is better with the investor, I agree with BlackRock's definitely digging in on this. I think you are to an extent. I guess would you, if you couldn't get out with in kind in the first tranche, would you do cash for the time being until you could figure out in kind?
So I actually think the answer to both of these last two questions is the same thing. Being first is going to be critical. Obviously, first mover advantages, we get all of that, not arguing it. I think the next thing that's going to be critical that is currently undervalued is the way the primary market operates here, and primary market efficiency is going to drive an enormous portion of how these volumes actually play out. Because there is no standard, right? No one has done this with these providers in America before. Now, we've been operating a primary market in crypto ETFs for 5 years. So we have a pretty standard playbook that we know leads to an efficient market. There are some obvious differences as you move between geographies, but that piece, the operational know-how of how to make this primary market go correctly is going to end up playing a huge role here on both sides, right? It's about how do you make that market work as effectively as possible, because it's going to show up linearly in spreads. So the better you can do, the more cost you can take out of it, the more efficient you can make it, the easier and cleaner you can make it for market makers to hedge, the better this is going to be. And that's going to end up driving a big chunk of how volume plays out. You need those markets to be tight, and providing a really stable, very well-structured primary market is going to end up playing a really big role here. And so to answer your original question on like, how do you do this? I think you lean into that operational experience. There isn't anybody else in this race that has actually done this before. Lots of people, and they're good firms. They probably can do this, but they don't know how to do this. They haven't done it.
Well, let me push back a little. Using operations as your marketing, again, you're going to put some people to sleep. I think people are going to just, I think there's maybe some, if the spreads are different, surely that definitely speaks to that. Like no one wants to pay 10 bips versus 1 for sure. But you're talking about BlackRock and Fidelity. I mean, people look at BlackRock as the ETF king. They've got 450 funds. So I think I got to assume they'll be somewhat good on that front. But, we'll see. I know you have this, you have the experience in Europe. But like I said, I think it's going to be tough for everybody.
Eric, can I as a student of disruptive innovation, I'd like to make a couple of observations here. One, and maybe I didn't emphasize this enough in the beginning or concretely in the beginning. 21 Shares is the largest pure play crypto ETP player in the world. And as a student of disruptive innovation, we're maybe not thinking about this, ETFs when it comes to equities and fixed income, well-worn paths. ETFs when it comes to crypto, Bitcoin, we think very different. And I have been incredibly impressed. Tom Stout, as well, of course, our president and COO, working very closely with Ophelia, at how much does go into this. So it will be very interesting when we get off the mark here, off the block, to see what happens. Let's test this out.
We talked about the operations. What else? I mean, this crowded race that we've been talking about, like and to have somebody like a BlackRock be out there, how else do you distinguish yourself in such a crowded marketplace if there's multiple people off the blocks at once? Like, the race is going to start all over again, right?
And let me just jump in here for the listener. As an ETF nerd for almost 15, 20 years, this is fascinating. You've never had a situation in the history of ETFs where they've let everybody out at the same time and all the funds do the same thing. They offer Bitcoin exposure. So it's the first time we've had I'm calling it, by the way, I'm trying to coin this phrase, the Bitucky Derby. What do you think about that? You like that or no? Joel, what do you think? Bitucky Derby? Because
we'll talk about it offline.
It's like a horse race. And, some don't make it to the starting gate, Joel.
Eric,
they have
Eric,
to.
I got it.
Anyway, so this is the first time you have a natural horse race. So this is a case study from heaven if you're an analyst.
I think the other piece of our marketing positioning here and how we think we differentiate in this market, experience is part of it, ops is a part of it. That's my background, so I tend to overemphasize that, and that's on me. The other half of what it is we do, which is extremely unique, is it's research. At the end of the day, we give it away. It's free. It's best in class. We're the only two firms on the street who do that, who can actually sit there and provide the client support. Right? You want to sit down with an advisor and help them understand how this can fit into their client's portfolio, how they can support their clients through that when there's a problem, they can pick up the phone and call somebody who will explain to them what's happening in crypto. That's actually a huge piece of missing component in how you actually place these assets. And bluntly, that is not something people get from the king of ETFs because that's not actually their specialty. That's not their approach to the market. Never has been.
Another thing is, and I'll go back, of course, to the research side of it. We have been researching and writing about educating our client base, prospective clients, anyone who wants to read our research since 2015, when Bitcoin was $6 billion, $6 billion in market cap. Today, it is roughly $700 billion in market cap. And again, we think we've just begun. But I think we've earned some stripes because all we do, 3 analysts focusing on crypto, and we have partnered, our distribution partner here in the US, Resolute, the entire firm. It may be much smaller than BlackRock, but they have been working with us on disruptive innovation, exclusively disruptive innovation, and are incredibly excited and confident that that we can make a big splash.
First of all, good luck to you. I think this is going to be fascinating to watch. One just last question about ARK in general. And obviously, this has been quite a journey for you. You came, and I remember meeting Cathie at the ETFs boot camp. I think you were 2 months before launching. And I swear, you told me the idea. I was like, yeah, I don't know. I might not see her next year. Because at the time, nobody wanted active. But you proved me wrong. And you went from zero, and as an indie especially, it's hard to make it. I think you might have peaked at 30, 40 billion. It's now, your funds are 14 billion. You've had that huge run up, huge run down. Now you're up again this year. It is a bit roller coasterish. Your journey kind of reminds me of Steve Martin's quote in his great biography called Born Standing Up, where he goes, "At first I wasn't famous enough. Then I was too famous, like when The Jerk came out." And he goes, "Now I'm just right famous." And it sort of feels like that. Do you think 14, 15 billion for your equity ETFs, let's move crypto aside, is that the right spot for you? Because, you're less visible in the markets now. You're not like pushing stocks around. Or do you want to be bigger or smaller?
If we are right, and this is not just about crypto, it's about all of the innovation platforms around which we have centered our research and investing, then disruptive innovation, broadly defined, will go from roughly $15 trillion in market cap globally, equities, both public and private, so a little more than 10% of the market, to more than 200 trillion by 2030. And we think we should gain share in that market because this is all we do. And so that Steve Martin quote is very interesting. In late 20 and early 21, I was very uncomfortable. I'm on record saying, keep some of your powder dry. We can't do anything wrong. And I sent this to my team too. We can't do anything wrong. This is not reality. There's going to be another side to this. Did I believe Michael Burry when he said, this is just the NASDAQ circa 2000? Absolutely not. And I told him, you don't understand innovation. Well, what I didn't understand was the Fed was going to take interest rates up 24-fold within roughly a year's time. Never happened in history. Volcker took it up twofold, 10 to 20%, but only twofold. 24-fold, shocked the system. I think we've paid our dues, and I think we're on the other side of it. I'm much more comfortable today that many people don't think we can do anything right, although that's changing with this year's performance. But innovation gains traction during tough times, and that's what's happening. Our companies are now earning their place in our portfolios. Their earnings are surprising to the high side, and they're moving to the top of the heap. So, no, we're really excited about the next 5 to 10 years. This is why I started ARK.
Okay, we'll leave it at that. Cathie, Ophelia, thank you so much for joining us on Trillions.
Thank you, Joel and Eric.
Thank you, guys.
Thanks for listening to Trillions. Until next time, you can find us on the Bloomberg Terminal, Bloomberg.com, Apple Podcasts, Spotify, or wherever else you like to listen. We'd love to hear from you. We're on Twitter. I'm at Joel Weber Show. He's at Eric Balchunas. This episode of Trillions was produced by Magnus Hendrickson. Bye.